Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. Right now is earnings season, and a lot of stocks are kind of jumping all over the place. We got some stocks that are up 10%, some stocks are down 10%. Lots of volatility and uncertainty in the market, especially with the elections coming up next month. And we really don't know what's going to happen there. And that's like a whole nother binary event that we need to sort out before volatility drops. So in this video, I'm going to talk about 5 ways that we can reduce our risk when we're selling options, specifically the wheel strategy. A lot of people say that the wheel strategy is like a risk-free way to make money, and I disagree with that. If you sell a put and it gets assigned and the shares are below your strike price, you're still losing money. You still have less money when you take those shares than when you started out. So there's some risk involved. And especially with something like what's going on right now, may be a good time to reduce some risk in our portfolios. Before I get into those 5 ways of reducing risk though, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, and document my own journey towards financial independence. So I'd really appreciate if you give this video a little thumbs up, and if you subscribe to the channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. Now with that out of the way, let's talk about how to reduce some risk in our options portfolio, or selling the wheel strategy. The first way is diversification, just selling different options in underlying companies in different sectors. There's a lot of ways you can do this. You can sell options on things like SPY, which is the S&P 500. You can sell Qs, which is the NASDAQ 100. You can sell TLT, which is the bond market. You can sell IWM. You can sell GDX. You can sell USO. All kinds of different ETFs and different companies that you can sell in different sectors that have, exposure in all kinds of different places. So hopefully if there's like some sort of dust up in a certain sector, your whole portfolio doesn't get hit. Second way to reduce some risk in your portfolio is stick to either quality companies. Quality companies have good fundamentals, have been around for a while, paying a dividend. Premium may be lower because, they're less risky, but that's a good thing if we want to reduce risk. Or we could even do something like selling ETFs. A good thing about ETFs is they don't have earnings announcements, so they don't have those big wild swings. And, there's a lot of different companies in the ETF, so selling, or if there's trouble in some of the companies, it'll kind of wash out, and the volatility of the ETF will be less volatile than the shares, individual shares. Along these same lines is don't be selling the wheel strategy on kind of high speculative positions, things like TQQQ, the Q triple leveraged ETF that has really high premium for a reason, because there's more risk. Also something like NEO, lots of high premium, but lots of risk. Tesla even. And I know a lot of people love Tesla, but that thing can move around up and down a whole bunch. So maybe, just maybe, you want to lay off selling the wheel strategy on Tesla for a little while. Next, there's position sizing. And just because you can afford to sell the wheel on SPY doesn't necessarily mean that you should. There's a lot of other ETFs and positions that you can hold to reduce your risk. An example of a really good company, but with a bit of a high share price, would be Apple. With, you need about $11,000 put away to sell one contract on Apple. And that may be a lot for some people, and it'd be hard to, have a lot of different positions with a share price that high. But if you have the portfolio to do it, by all means, go ahead. So imagine if you have something like a $50,000 portfolio, you can limit your share prices to, maybe like $70 or maybe $50. That way, $50, that's 10 different positions that you can sell the wheel on. And at $70, that is, about 7 different positions that you can sell the wheel strategy on. And there's plenty of ETFs and plenty of individual stocks that you can sell premium on for that kind of money. You have things like Wells Fargo, Bank of America. Those are both like $25. You have the ETF of XLF, which is the financial ETF. That's $25. But back to our diversification, Wells Fargo, Bank of America, and XLF are all in the same sector, so you may not want to sell on all 3 of those. You have SLV, the silver ETF, which is like $23. GDX, the gold mining ETF, that's $38. You have AT&T is about $28. Have Walgreens is about $38. ExxonMobil's $45. Intel's about $47. So plenty of different positions, plenty of good companies and ETFs that have lower nominal prices that we can sell positions on that, will reduce our position sizing. Next is sell monthly contracts. Now, if you do the math and you're like, okay, 4 weeklies, you look at the premium on selling 4 weekly contracts, it definitely adds up to more than 1 monthly contract. And there's more premium because there's more risk. Selling monthly contracts, you have a lot more time value associated with that. And that means you have a bigger cushion for the share price to move up and down before you get assigned. Another good thing about monthly contracts is you actually can go in the money, but if you have 3 weeks to expiration, those shares are not going to be assigned to you because you have too much time value left in there. But with a weekly contract, it goes in the money and the odds of getting assigned are much higher. And the 5th way to reduce risk when selling the wheel strategy is avoid earnings announcements. If you look at Intel, they just fell 10% on a bad earnings announcement. So, a lot of those contracts are going to get assigned. And a lot of those put contracts are going to get assigned, I should say. On the other hand, Snapchat, that jumped like 25% or something crazy. So all those covered calls are going to get assigned, and they're losing out on those gains if they just sold, a weekly contract on Snapchat. Kind of to tie in monthly contracts and expiration dates, I actually sold a put at the beginning of the month for an Intel put. I sold a strike price for $27.50. I got plenty premium for it. Intel rose in price for the first 2 weeks or so. Then they announced their earnings. They dropped 10%, but that contract is still not in the money as of making this video right now. It fell 10% and my strike price has not been hit yet. That's because I sold a monthly contract during an earnings announcement, so it helped me out a lot. Shares may get assigned still. I think Intel's trading at like $27.70 right now. They may get assigned, but for me selling the monthly contract, I had a lot more room to, lot more cushion, so I don't get assigned those shares when they had that bad earnings announcement. So I hope this helps you out with the current volatility in the market and your wheel strategy. If it did help you, I'd really appreciate if you give me a little thumbs up. Subscribe to the channel if you haven't, because I'm putting out videos every Monday and Wednesday. Leave a little comment down below. How are you handling this earnings season and the presidential election as far as your option strategies go? Are you just not trading right now? Are you not selling the wheel, or what are you doing? Just options, no politics. Don't want to talk about that stuff. All right, so I think that's all I got for this video. I'll put some other videos somewhere. And then I want you to go have a good day, all right? Justin out.